I'm David Merritt.
And I'm Francine Lacqua.
And this is In the City, Bloomberg's podcast connecting you to the stories and the voices at the heart of the City of London.
This week, a conversation with Daniel Pinto, founder and chief executive of Stanhope Capital. Now, Dave, you go to dinner and you never know how that dinner is going to go. You either sit next to someone a bit boring and you kind of, try and run the clock down, or you really luck out. And I sat next to Dan Pinto.
Wow. Well, there you go. Why wasn't I invited?
I know, next time. There has to be a French connection, but we'll make it honorary French, Mr. Merritt. Dan, thank you so much.
It's a pleasure.
Monsieur Pinto, thank you so much
pleasure.
For joining us.
Yeah.
Talk to us a little bit about Stanhope Capital, the way that you started and the way that this has really flourished into an independent alternative asset management.
So I founded Stanhope Capital in 2004, very much as the anti-private bank. Everything you dislike about private banks, I try to do the opposite. And the list was very long. And the concept was very simple. I noticed that many clients of the private banks were unhappy about the conflicts of interest, about the turnover of personnel in these banks. And I decided to create a firm that would put a client at the center of the company as opposed to the product. So we're not about selling, we're about advising. And guess what? It became very popular. And initially I started with the backing of 5 families who were former clients of mine at SG Warburg, a name that has disappeared from the financial landscape when it was acquired by UBS, but it was at the time a very prominent merchant bank. So these 5 families backed me, became clients of Stanhope Capital, and then the rest is history, as they say. The firm grew to become the largest independent wealth manager in Europe, with about $33 billion of assets under management, and a scope of activities that goes all the way from wealth management to private equity, real estate, and merchant banking.
You've had a ringside seat, obviously, to many changes across the financial industry in Europe as a result. What is the sentiment like in your industry right now?
Well, the city is going through a difficult moment. Undoubtedly, the fact that you've had announcements in the last couple of weeks that ARM is going to list in New York as opposed to London, that CRH, a prominent building material firm, is also moving to New York, Flutter, the gambling company, Ferguson, the plumbing and heating company. The list is long of firms that either were not public and decided to go public in the US, or were public in London and decided to move to the US or have a dual listing in the US. And the bad news did not start last week with all these announcements. The bad news started quite, a few years ago. The reality of London is that it is still the most prominent financial center in Europe. It is still attractive, I think, but I think we've lost a little bit of our competitive edge. And there are a number of reasons for that.
Is that Brexit?
Brexit was not helpful, but I don't think it's the only reason. I think the key reason is that the pool of money available for investment in the public markets in the UK has shrunk. The pension funds are investing less in public companies in the UK. And just to give you a sense, the size of the public markets in the UK was about 4 trillion during the Great Financial Crisis, or right before in 2007. It has gone from about 4 trillion to 3 trillion today. So, a pretty massive reduction in the size of the market. The decline in the number of companies being listed in the UK is also quite staggering. You have 40% less public companies today than in 2007. And the reason for it is primarily, as I said, the shrinking pool of money available for investment in the UK. So pension funds, because of the everything that has happened in terms of defined benefit and their difficulty in investing in public companies and their preference for investing in bonds in order to match assets and liabilities, that has had a very bad impact. But it's not just that. I think the regulatory framework in the city was not has not followed the times, if you will. In other words, where the US was quite creative in terms of creating a regulatory framework that was pro-growth, London has lagged behind. And that, we can give many examples, but listing rules, for example, are much simpler in New York than in London. If you want a primary listing in London, you need to comply with many, many more rules than in the US. And that has pushed the growth companies, particularly in technology, to go to the US, notwithstanding the fact that they have more investors in the US. They find more investors in the US, and that's a deeper pool of money. But the rules themselves have remained stuck in time, in a way, in London. And that's a problem. That's a problem. And there are many reforms that we can speak about to address the issues. But these are the issues that London is facing. If your question, Dave, was about beyond London, the worries about the public markets, obviously, we're coming out of a year that was very, very difficult for every market, but particularly equity markets and bond markets. And the attitude today of most investors is to hope that 23 will be a better year, to hope that monetary policy is not going to kill the nascent recovery of public markets. So that's pretty much the mood, to respond to your question.
It's a pretty bleak outlook then, isn't it, in terms of London? I'm just wondering, on this question of public markets and their size, I mean, London isn't necessarily alone in this process, isn't it? And is it particularly bad in the UK because the pension funds are acting differently? But there's been a trend in years of companies going private, of taking themselves off those public markets. That's not peculiar or unique to London, is it?
No, you're right. But I think London has suffered on two fronts. The public market side, as we discussed, for the reasons we discussed, i.e. pool of money that is shrinking, i.e. a regulatory framework that is more difficult. But London has suffered also on the private equity side. And why? Simply because the insurance companies and the pension funds, which normally, if you look at the US, are the biggest providers of money for private equity. Well, guess what? In the UK, pension funds and insurance companies find it very, very difficult to invest in private equity. We spoke about the public equity side, but that's true as well for private equity. And that means that we kind of missed out on both fronts, public equity and private equity.
So why are we so slow in the reforms? We actually spoke to Mark Austin of Freshfields that put all of these reforms in place. And he says, look, it's not too late to transform. I think that was 6 months ago. Do these things take time, or are we just behind the curve?
Francine, we are complacent. Complacency is the worst thing.
Regulators are.
Everyone. The market has been complacent. The regulators, investors, just to give you a sense, the fact that growth companies prefer to list in the US is not just linked to what we described, which is obviously they find a bigger pool of money. It's a cultural issue. The City of London is now full, if you look at the asset management industry, it is now full of value investors that are seeking dividends as opposed to growth. It's become a public market for pensioners, not a public market that is aiming at finding the big companies of tomorrow. It is seeking to provide dividends to pensioners.
When did that change?
Well, it's over time. I think it's a cultural issue. I think that London has always been quite skeptical about growth stocks because they obviously don't show the kind of profits that you would find in a more mature sector or more mature sectors. And, over time, the big London investors have missed the boat of the kind of digital revolution, for example. But, it's a market that goes very quickly. If you miss that boat, it's very, very hard to jump back on that boat. And today, as a result, the digital companies prefer to go to America or even to Asia to raise money, or to the Middle East to raise money. And so that's the issue that we have to deal with, I think.
But it's interesting also, isn't it, that New York is the beneficiary here. And, we want to come on to Paris as well, but we've seen that market overtake London in terms of size. Why aren't some of the growth companies choosing the rest of continental Europe or the European Union to list? Are they also facing some of these same structural problems?
Yeah, same issues. You don't have a community of investors in Europe, I'm talking about the continent here, that necessarily understand the growth sectors as they would in the US, and is not as willing, if you will, to put the right kind of valuations on these companies. I mean, there is a discount today. When you look at, New York has always traded at a premium to the UK and Europe in terms of valuations. Today, the discount is 30 to 40%. When you look at valuation metrics, it's a lot. The value investors would argue, well, that's why we are right and they are wrong. They are paying too much for these companies. Well, that's, if you go back 15 years, you go back to 2008 and you look at the performance of the US equity markets, S&P 500, against the Eurostoxx 600. The outperformance over the period is a factor of 3.5 times. The US has done 3.5 times better than Europe and the UK. So we have to wonder why. And the reason is very simple. You look at the sector breakdown of the S&P 500. About a quarter of the index is comprised of technology companies. You look at Europe, 5-6% of Eurostoxx is technology companies. So if you assume that the future of growth, not just growth of the top line, but growth of earnings, so value creation, if you assume that value creation will still very much revolve around these growth sectors, which have been disliked in 22. But it's a parenthesis. Let's not lose sight. The future in terms of value creation remains in these kind of sectors. If you assume that that's the case, then we have in Europe, and when I say in Europe, I include the UK, we have a problem. We have to find a way of backing these companies from the point where they are young, with a sufficient amount of private equity capital available for growth companies and venture capital. And we don't have enough venture capital for the reasons I've mentioned, to the point where they become more mature, go public, and then you have to have a different investor base of large insurance companies and pension funds that are willing and able to follow them. We don't have that.
I mean, you're talking about the ecosystem, but is there something more immediate that ministers, and we meet young ministers or regulators that are hungry, have fire in the belly, and want to make a difference? Is it too little, too late? I remember Rishi Sunak pitching quite hard to get Deliveroo. Now that was a flop, but at least he got them here.
Yeah, and it takes quite a few participants, if you will. Start with reform that has to come from the government and regulatory bodies. Lord Hill, as you know, had produced a very good report about ways of making listing rules more flexible and more aligned with the US. Not much has happened since, even though the Edinburgh reform, as you recall, the Chancellor had come up with a big plan, which was supposed to be Big Bang 2.0.
Right, got scaled back somewhat, didn't it?
You haven't seen Big Bang 2.0 at all. It's like nothing happened. And that's because there is a kind of unwillingness to really act quickly. I think regulatory reform will involve the government, will involve the regulatory authorities. Listing rules have to be changed. And also rules pertaining to pension funds in the UK and insurance companies in the UK have to change, and they have to change quickly.
You know, we've got a prime minister who's a Goldman Sachs alum. You know, we've got a chancellor who's a former business person. I mean, this is supposed to be kind of the dream team for the city. So I guess, you know, if not now, when? I mean, surely this is the best chance of getting some of these sort of reforms through. It feels extraordinary that we're not getting that sort of movement from this government. I mean, I guess we've got a budget coming up fairly soon, so maybe we'll wait and see. But as that rollback of the Edinburgh reform shows.
I agree. It should be the focus. I think they have been very busy on basically saving the economy.
Right.
That little distraction.
Yeah.
A little distraction, but I think we've passed the worst.
So they've done that, right? I mean,
that's right.
Yeah,
we've passed the worst of that period. So now they should have a bit more time and energy to focus on that, because it's quite essential. It's not just essential because we want a thriving financial sector. It's essential because the financial sector represents about 10% of UK GDP. So it's not a joke. I mean, it's a very important sector for the economic growth of the country. And it's not just because it is 10% of GDP that it's important. It's because with a thriving financial sector, you have the means to actually finance the economy, both in terms of equity financing, private and public, and in terms of debt financing. If you don't have that, you have an economic problem, not just a financial problem.
What do you think the Chancellor should do in the budget for either corporation tax or individuals?
I know that the temptation is to raise corporation tax. I think they should really be careful about that, because to add that on the table at this stage would be a mistake. I think that there should be a clear statement about a desire to deregulate a little bit. I mean, it's not about, let's not throw the buzz terms of Singapore on Thames, etc. I don't care how it's called. But clearly, our regulatory framework is too rigid, and that has to be addressed. We should make London more attractive to foreigners, not less attractive to foreigners. And that's true for foreign companies and foreign individuals. So all kinds of things need to be done post-Brexit to make London more attractive.
I mean, in a cost of living crisis, that's probably not going to go down well.
True, but people should understand that it's not because you reduce tax on one side that they suffer. Actually, sometimes you have to reduce tax or keep tax as it is in order for the entire system to benefit and for people that are suffering today because of the cost of living crisis to do better, to earn more. And there is a collective responsibility to ensure that you make London and the UK more attractive to corporations, for more jobs to be created and for people to make more money.
I mean, you mentioned them having to save the economy. Of course, it was only, just a few months ago that, and you talked about the pension industry, that it was teetering on some sort of systemic collapse because of the budget under Liz Truss. And the damage, we've spoken a lot about this on this podcast, Francine and I, about the damage done to Britain's reputation. Has that now healed under this government? Do investors not look at Britain with the sort of trepidation that they did last autumn?
It has healed to a large extent, but I think that the psychological shock was serious. In other words, who would have guessed that sterling would be perceived as a weak currency? Who would have guessed that, the UK government might have been derated by Standard & Poor's and Moody's? Who would have guessed all of these things? So I think we are out of the worst of this crisis of confidence. But I think we still have some way to go to reassure markets that it's not going to happen again.
I mean, I remember, Dave, that autumn, I was in Italy covering the Italian elections, usually very volatile, very market moving. And I remember being recalled back to London because actually we thought we were on the brink. Why have the pension reforms not been on the back of that, dealt with quickly? Again, do these things take time, or are they just dragging their feet?
They take time, and without jumping into the details of the pension reform, which is highly technical, you will recall that most of the pension funds in the UK were organized around so-called defined benefit systems, which had the disadvantage of creating a kind of fixed liability for companies. And if the money was invested in public markets, equities and bonds, if markets fell, suddenly a deficit was created. The rules have changed many years ago to ensure that deficits cannot increase without limits. And what happened is that these rules have pushed many of these pension funds to dramatically reduce risk, i.e. exposure to equities, at the point when they are in deficit. But guess what? The best solution to fight against this deficit and go into surplus was to stay invested in equities, was not to shrink your equity exposure to go into bonds, because then you have no capacity to rebound. That's the kind of rule that had a good intention, i.e. make the pension funds safer, but ultimately made pension funds stay in deficit forever without any capacity to rebound. In addition, has created a system where there is less money available for equities. So you had two collateral damages that were completely unintended, but have to be addressed today. So this kind of reform would require, the regulators and government sitting with the managers of pension funds and making the system evolve. It takes a bit of time, but they really should get cracking because time is of the essence.
Do you see any evidence that they're doing that? Or
No.
do you say, no, they're not
on this front, no. Not yet. I haven't seen that. What they are trying to address at this stage, for example, is insurance companies. So not pension insurance companies.
Solvency II.
Solvency II. So they understand, again, looking at the US model, which is not perfect, but at least it's a model that pushes the large institutions to really invest in the economy and in the growing companies. They look at the US model and they see that the large insurance companies can invest a meaningful portion of their assets into private equity, both buyouts and ventures and venture capital. And they say, well, we have large insurance companies in the UK. We have Solvency II that is preventing them from investing more for the long term. What can we do about it? So they want to now benefit from the fact that with Brexit, they are no longer bound by Solvency II rules in order to enable these insurance companies to be a bit more proactive. It's mentioned, at least there is intention to reform, but the measures haven't been taken.
No,
So,
but I mean, is that a reform that you think is necessary and the right path?
Absolutely necessary. Again, there was this perception way back, and that was it was well-intentioned, that if you're an insurance companies and you have to make sure that you can meet your liabilities vis-a-vis the holders of insurance policies, you should not invest too much in illiquid assets, such as private equity. It was perceived as risky. But guess what? You look at the track record of private equity over the last 10, 15 years, it was the best asset class to invest in. Yes, illiquid, but people who have done it intelligently have done tremendously well.
If you were the city minister, Daniel, then, or even the chancellor, perhaps, what would be the first thing you would do in this budget to get things moving in the right direction? What's the most urgent reform?
I think I would address the issue of pension funds immediately, because that's where most of the money is. And again, it's not something that is easy to communicate from a political standpoint because people don't understand.
Doesn't get you votes.
Well, it doesn't get you votes. But you know what? It has to be done. So I think I would start with that. And secondly, I would address the issues identified by Lord Hill and would actually implement the whole Lord Hill report without delays. And I know that they want to do that. And again, this is not, you cannot explain to the public, it's so essential to change the listing rules. But when you understand the consequence of that, you do understand that it's absolutely essential. So I would prioritize that. And I would certainly not announce, and I know that there is pressure on the budget, but I would not announce, an increase in corporate tax. That would be the worst moment to do that.
Talk to us, Daniel, about the Windsor framework. So this, Dave, can we call it the Sunak Brexit deal? And whether it makes that much of a difference to UK-EU relationships and whether it means that we'll get equivalency and how much of an impact this has on the City of London.
So I don't think it has a direct impact on the City of London, but I think it changes the atmosphere completely.
I mean, it's a very different tone, isn't it?
It's exactly right. Yeah, and tone is important. I would not underestimate. It doesn't get you deals,
does it?
It doesn't get you deals. No, it doesn't get you deals. But if you want to, because, as you know, there was an attempt to sign deals 18 months ago, and it has failed miserably. Europe was not willing to sign deals, particularly in the world of financial services. I am not saying that Europe, post the Windsor framework, would jump back at the negotiating table and say, let's sign deals. But I think that it's the start of a new phase, if you will, in the relationship between the UK and Europe. And I think the tone has changed. It's much more friendly. And you've seen the pictures of Mrs. van der Leyen and Rishi Sunak.
Oh, yeah, it's very flirty, even.
Very,
I can say that.
I wouldn't go that far, Dave.
I would say friendly.
I mean, flirty, maybe if you're like a UK all-boy public school,
yeah,
but
that's right.
Not by any European standard.
And wait until she meets Macron. No, that's great. Jokes aside, I think it's great that the atmosphere has changed because it was silly for the last couple of years. And again, regardless how you feel about Brexit, it's very, very clear that there has to be a better relationship between the UK and Europe being its largest trading partner. And I think we are getting there. So I think that's a feather on the cap of Rishi.
I mean, the equivalence question is a different one, though, isn't it? Because I don't see where there is an incentive on the European side to agree any more concessions. I mean, we read pretty much every week, it feels there's another story about expansion of banks, particularly in Paris, as trading and investment banking and all of these things going. So I'm not sure, why would the European Union want to sort of unlock the gate again for the City of London?
No, they will not. In the short term, they won't. Let's not delude ourselves. I think you have to give it a bit of time, and perhaps slowly we'll be able discreetly to negotiate new things for the UK. But you're absolutely right, Dave. I don't think they will unlock the door anytime soon. We have to be patient. That's all. You mentioned something earlier about Paris having become the largest equity market in Europe, above London. And there is a reason for that, which is that, as you know, the French and the Germans have been able to keep the ownership of their largest companies, including listed companies, in the hands of certain families, such as Arnaud with LVMH, such as the Dassault, such as the Peugeot, the list is very long. For some reason, the UK has not been able to maintain family ownership or founder ownership in its largest companies. And it's a big difference and it's a big issue. So we are, in a way, and that's really the challenge that the UK has and London has. On the one hand, we do not have the large growth companies that you find in the US, particularly in the world of technology. On the other, our largest companies are not held by founding families of founders, but they have a capital which is widely spread. Why is it an issue, if I may? It's an issue because if you are, Arnaud, holding over 40% or 45% of your company and the majority of the voting rights, you don't really care about the volatility of your stock. You can invest for the future without worrying too much about your quarterly results. I'm not saying they are immune to the dictatorship of the markets in terms of quarterly results, but they are less inclined to make the wrong decisions because they are under pressure from the financial market. In other words, they are not thinking short term. They are thinking long term. The problem that we have with many of our large public companies in the UK is that they are led by professional CEOs who are not substantial shareholders, most of them, and they are terrified of the quarterly result, mentality, if you will. And that is bad. The US, again, with all its flaws, when you look at the largest public companies, particularly in the world of technology, many of them are still founder-led or founder-influenced. And that, again, puts them in a position where they can invest for the future without necessarily being too focused on short-term results. And I think that's another element that we have to think about carefully when it comes to the UK economy and the UK market.
There's a big cultural sort of or an attitudinal difference here, isn't there, between the way that London has been run versus Europe? I'm just thinking about the ARM example that we mentioned. Of course, it used to be listed in London. And remember, after the Brexit vote, it was held up as an example of how Britain was still very attractive when SoftBank swooped in to buy it. And the government let that transaction happen. It would be very hard to see that have happened in France to allow a foreign takeover of the biggest technology company, for instance. But again, the government here at the time celebrated it and said, look, investors want to buy Britain. So that's that fundamental difference, isn't it? That really Britain's companies were for sale and the Conservative government were very happy to see global investors snap them up. Whereas I think in France, it's kind of unimaginable to see that. Yeah,
I mean, that company, clearly, you're right, Dave, that company would not have been sold to a foreign entity in France. It's very clear. I'm not saying that France is right. I think that France, as you know, has been much more protective of its corporate leaders, particularly in the world in sectors which are deemed to be strategic. And clearly, ARM would have been deemed to be
they also think
super strategic.
And yogurts.
That's right.
Are strategic.
Yeah, if they said that yogurts were strategic, you can imagine that ARM would have deemed to be very strategic. They go a bit too far. And the UK has probably been a bit too loose in terms of letting its most promising companies be acquired by foreign firms. But let's not forget the positioning of London has always been to be a platform for the rest of the world into Europe, into the European market. Now, Brexit has sadly a bit changed that, but London exists as a financial market because it is a platform, because it is perceived as a bridge between the US and Europe, and is perceived as friendly to Asian investors. If London had been overly protective and had blocked the acquisition of some of its largest businesses, that role as a platform would have been jeopardized. And the DNA, if you will, of London might have changed. You have to look at the cultural history and background of each respective market to know what's right, what's wrong. I don't think that the French recipe would have been appropriate for London.
Daniel, if you were to start Stanhope Capital today, would you still do it in London?
That's a good question. So I started Stanhope Capital in London because it was the most pan-European city when I started about 20 years ago. And I said to myself, if you want to start a business in the world of financial services in Europe, where should it be? And London was clearly the answer for that reason. I would still do it in London today because I think that London has kept an advantage over many other capitals in Europe. It is still in my mind, put aside the issue of the size of the equity markets and Paris being bigger than London, the ecosystem of London is unmatched. I mean, I would love to tell you that Paris is getting there, but it has a long way to go before getting there. The ecosystem in London is unmatched. And when I say ecosystem, it's the financial world. It's, obviously the world of advisors, the lawyers, the accountants, the trustees. I mean, there is a whole ecosystem that makes London absolutely unique. And I think if you assume that being a bridge between the US and Europe is important and can be beneficial, I don't think that any other city in continental Europe can claim to be that bridge. So London has this natural position, if you will, that is not about to disappear. So yes, I would still start my company in London, but I would very soon thereafter create entities on the continent as well, which I did subsequently because we now have 4 offices in Europe. We have 4 offices in the US and 4 offices in Europe, including in Paris, as a matter of fact.
So an optimistic vision for the future for London, despite all the problems we're seeing.
Yeah, I think we are going through a rough patch in the UK, but I think that we can address it and we can rebound. I mean, absolutely convinced of that. But there has to be awareness that reforms are not just necessary, but urgent.
Daniel, how many emails do you get from the other Daniel Pinto, JP Morgan? There's like 2. I have to ask because I was fascinated. I mean, literally.
Well, we know each other. I know him. And the biggest problem is not so much the emails; it's the bookings in London restaurants where they never know if it's him or me. And the worst thing is that we have the same middle initial, which is Daniel E. Pinto. So there is no way to...
Do you have a similar taste in restaurants?
Well, yeah, kind of, yes. Apparently. But he spends most of his time in New York now. So, it's become less of an issue. He used to be based in London, but now he's based in New York.
I love that. Daniel Pinto, thank you so much.
Pleasure.
Thanks for listening to this week's In the City. We will be back next week.
But in the meantime, if you like our show, please head on over to Apple Podcasts or wherever you listen to podcasts and rate, review and subscribe.
This episode was hosted by me, David Merritt.
And me, Francine Lacqua.
It was produced by Summer Sadi.
Additional editing by Blake Maples. And a special thanks to Daniel Pinto.